Recently, I made a video discussing why revenue growth is not overrated, talking about how you need revenue growth in a company to make a 10x stock. But that's not all you need. Looking at 10x stocks like Nvidia up 20,000%, or some of these lower 10x stocks still up 1,200%, life-changing returns. Yes, you need revenue growth, you need sales growth on average 45%, and yes, you need profit growth on average 29%. However, valuation growth is somewhat underappreciated on this list at 23%, and that is for stocks in a 10-year return period. However, while revenue growth and earnings growth are the two main drivers to find 10x stocks that will 10x and make generational money for you in 10 years, that changes slightly if we change this up to 2-year returns. If you look at some of the best performing stocks in the past 2 years, multiple expansion is a significant contributor, right? A lot of these stocks are over 50%. Everyone that's highlighted in yellow is over 50%. Approximately half of the stocks had more than 50% multiple expansion. In fact, if you average it out and take out a couple of the outliers that had significantly high earnings growth of 90%, 97%, 99%, the average multiple expansion is 50%. So while we're looking at 10-year returns, we're really looking at revenue growth and earnings growth as the main driver. If we're looking at shorter 2-year returns, we simply cannot ignore valuation. And why am I telling you this? Because on my channel recently, I've covered a lot of stocks that I consider to be beat up. Share price is down. A lot of people are saying this stock should be thrown in the garbage, not highlighted on your channel, Cameron. Valuation's down because there's a problem with it. There's a risk, and yes, I completely agree with that. But we need to balance the risk over the reward, and we need to look if some of these stocks, some of the best performing stocks, can make some changes, fundamental changes to the company, to the business, and start showing improvement. Can we see a massive 2-year valuation jump and significant returns? Today, I'm introducing the company, the stock, zomd. My name is Cameron. This is Common Sense Investing. Let's go find a great penny stock. What does zomd do? They accelerate growth across the digital marketing landscape. zomd bridges the gap between ambitious brands and measurable outcomes. They leverage expertise in performance marketing to orchestrate data-driven campaigns that conquer any KPI across any digital channel. Fortune 500 brands and leading app developers trust zomd to unlock their full potential. So to make this as simple as possible, zomd helps advertisers achieve their goals using data and their patented performance-based advertising platform. And that seems to be working, as zomd is recognized as a top app marketing company for 2024 by the Business of Apps. Now, before I get into share price and numbers, do not forget, I'm not a financial advisor. I'm definitely not your financial advisor. This is not how to invest. This is simply how I invest. I could be wrong. This is just my opinion. I love talking stocks. I hope you do too. This is zomd's 1-year share price, down 5% today as I record this to 16.5 cents Canadian. On the year, however, they are up 106%, and year to date, 135%. This is their revenue in green and their expenses in yellow and red, and you can see it's been declining since about late 2021. So how is share price up 100 and some percent if revenues are declining and expenses in some cases here are much higher than revenue and this company is losing money? Well, for long-term zomd shareholders, it hasn't been easy. Yes, it's up 106% in the past year, but over the past 5 years, it's down 86%. It does look like they've hit about $1 a couple times now and down to 16.5 cents. So when we go revisit the slide deck here, this starts to make a little bit more sense. Revenue down from 16 million here in 2022 down to 8.7, and of course operating income from 932 to pretty low and even negative numbers, which is why that declining share price over the past 5 years. However, the nice thing about publicly traded companies with competent management is things can change. I hate to tell you that. It's one of the more difficult, but one of the more beautiful things in the stock market. Things don't stay static. It's not always easy to say this is going to be a great company for the next 10 years or this company is going to be terrible for the next 10 years. Good management teams, good companies can change their outcome. And you can see recently here for Zoom, they seem to have made a significant change. Where green is up and red is down, yes, in the past 3 quarters, their revenue is up, and in the past 3 quarters, their operating income is up. So despite the significant headwinds that this company is facing, the past 9 months has shown improvement, to the point that their most recent quarter, first quarter of 2024, showed an earning per share of, well, half a penny, but it's earnings and not a loss, which they previously had. And the company is trying to communicate the change that is occurring as best as they can, because although the company discontinued several operations that no longer align with their vision, they did increase revenues by 1%. So it wasn't a massive decline despite getting rid of a whole bunch of stuff that was making revenue for them, right? Last year, they went through strategic measures that were implemented by the management. It led to adjusted EBITDA of $1.2 million, which was a $1 million increase. That's not bad. Net income this quarter of $0.5 million after 6 consecutive quarters with a net loss. At least you can admit you had 6 pretty bad quarters here. They're trying to change that, and finally a net income. Very small net income, but again, it's positive change. Ended Q1 with a cash balance of $2.3 million and no long-term debt. Now, in my video, Finding the Next 10x Penny Stock, I talk about how one of the best ways to find these life-changing type investments are to look for things that are trending in the right direction, usually trending up. So while a lot of investors have things in their head like, well, I need 25% or more revenue growth, or I need 35% or more margins, one of the things we can use to make data-driven decisions is whether or not a company is trending in a good direction. Is revenue trending up? Is earnings trending up? Is cash trending up? Is ROIs trending up? Is valuation, a little bit of what I'm talking today, trending up? It's not necessarily a snapshot in time that we're looking at here, because again, this company is fairly quote unquote beat up and they have struggled in the past couple years. We're looking at, are they improving? Investing is analyzing the historical trends, recognizing those historical trends, looking at the share price, making sure that it's valued correctly based on those historical trends. But then you also need to predict future ones. So is this company trending up? Well, the answer is it depends. If you look at Zoom's revenue, past 3 quarters trending up nicely from 7.1 million to 8.7 million. Operating income or loss trending in the right direction from negative 78,000 to 589,000 in the past 3 quarters. EBITDA up from 492 to 1.18 million. Those are some good trends. But again, how long do these trends have to go for? Because in the past 9 months, they've shown improvement. But that's after a significant decline from 2022 March, $16.2 million of revenue. So are you looking at the past couple years, or are you looking at the past 9 months? That's up to you. Is cash up? Well, again, a little bit confusing, right? In the past 9 months, cash from operating activities can best be described as lumpy, from 184,000 to 911,000 back down to 39,000. Margins are lumpy. A lot of microcaps are lumpy. That's why we need to look for trends so much. But if you do look at free cash flow margin and operating cash flow margin, that has been trending in the right direction. So is cash improving or is cash getting worse? A little bit of both, right? Some of these microcaps struggle for consistency. I would say that Zomd is doing better. And look, I don't make these videos for my own health. Some of them can take me 4, 5, 6 hours, sometimes more, to research the company, script the video, record it, edit it, everything else. If you want a full detailed analysis of Zomd, then hop on down to my Patreon. I will put that down in the paid comment, and we're going to talk more about whether this company is an obstacle or a potential opportunity for new investors. But here on YouTube, I will say that this looks, quote unquote cheap at this point. $16.2 million market cap. That's the price to sales for this company is 0.39. Enterprise value over revenue of 0.42. And EV over EBITDA, according to Yahoo Finance, is 5.75. Although you have to go check all of these numbers. This is a $16.2 million market cap company that's making $32 million of trailing 12-month revenue. This is beat up, right? This is significantly undervalued if it were a growth stock, if it were showing growth. What it is it's priced for a lack of growth and or declining growth. And fair enough. Recently, they only had 1% growth. And if they can't change that, they've been in a slump for the last couple years. They've only had about 6 to 9 months of improvement. If they can't make that change, then they could continue to be undervalued. However, if you think that zomd hit the bottom 6 months ago, 9 months ago, and they're significantly undervalued today, and they have potential to start trending in the right direction or continue trending in the right direction because they've already put in a couple good quarters recently, potentially this could be a good stock. Let me know down in the comments if you think there's any risk or reward to zomd stock, whether or not you like it, and what you think. Are you going to become a shareholder of zomd Technologies? My name is Cameron. Thank you for your time.